Hello friends, welcome to Financial Nirvana channel, the way to financial freedom. I cover topics of your interest, which helps you to plan your financials and attain financial nirvana. So please subscribe my channel and click on bell icon to get new video upload notification. Now let's discuss about today's topic, should we borrow loan, manage smart way. Free credit reports, low teaser rates, no application fees and super fast approvals. Banks, non-banking financial companies, and loan aggregators are doing everything they can do to attract new customers. You can apply for a personal loan online and the money reaches your account in a matter of minutes. But before you take a loan, make sure you are doing it for the right reasons. Don't borrow just because the interest rate is attractive or you can claim tax benefits. Here are few thumb rules to follow when you take a loan. We are going to make this topic into two parts. In the first part, we will cover the four different stages you will be into depending upon the percentage of EMI you are paying against your net monthly income. And we'll also cover the different kind of loans which generally people go for and what will be an ideal percentage of EMI against your net income you can pay so that you are in a comfortable stage. And finally, in case if you go for a long tenure housing loan or any other loan, how can you reduce the tenure which will help you to invest the same money into a better saving instrument and growing instrument rather than keeping the tenure for a long and keep paying your EMIs. And in the second part, we are going to discuss more in detail about each of these three topics so that we can make a wise decision of taking loan and the balance amount we can invest in the right instrument to grow the money. Now coming back, we know that a smart borrower will never bite off more than he can chew. The loan EMI should not push you into a corner. So generally, based on the analysis, we can put any individual into four states. First one is comfortable, second one is caution, third one is stressed, and the fourth one is alarming. So in case if you have taken the loan and for which the EMI is almost close to 20 to 25% of your net monthly income, that means you are into a comfortable stage and you can pay back the EMIs comfortably without putting a burden on your day-to-day month requirement or your monthly expenses. In case if the same amount goes higher than 20 to 25% and you are paying almost 25 to 40 percentage of your monthly net income into EMIs, that's a sign of caution and you really have to start assessing the total loan which you have taken or the loan which you have taken, how can you reduce the EMIs either by paying upfront some amount and reducing the EMI burden which you get every month. There are times when people end up taking much bigger loan and then they end up paying much higher amount as an EMI than what they should be ideally paying as an EMI. So third stage is a stage where you end up paying almost 40 to 50% of your net monthly income. And friends, this is a stage which is called a stressed stage because your total 40 to 50% of the monthly income is going into EMIs and the balance you are left with will be spent either in your monthly expenses, and what you are left is basically very little amount or no amount to really invest and grow your money which you can use for your future. And the last stage, which we call it as alarming stage, in this stage an individual is almost paying either 50% or over 50% of his monthly net income into EMIs. Ideally you shouldn't get into this stage, but in case if you are into, this requires a serious analysis on all the EMIs and all the loans which you have taken and start finding out ways to reduce the EMI burden which you are carrying. How do we calculate this percentage? It's very simple. It is called as loan to income ratio. That means what percentage of EMIs you are paying against your net income. So if you look at your pay slip, on the top you can see your gross income, and after paying all the taxes at the bottom, what you either get into your bank account or you carry to your home is called as net income. So in order to arrive at the percentage, it is called as loan to income ratio. you have to sum all the EMIs you're paying, right, against the loan. You divide that by your net monthly income and multiply it by 100. So you can see here the formula is very simple. Loan to income ratio is nothing but it is equal to total EMIs divided by the net monthly income you earn and you multiply it by 100, and that will give you a percentage, and you can fit that percentage into this 4 stage, and you'll know that you are either in a comfortable, caution, stressed or alarming stages, and you have to take an action based on that so that you're not putting an much burden on your financial income or the monthly expenses which you incur every month. Now let's talk about 3 important loans which generally people tend to go for. The first one is home loan. So the home loan, you should never cross more than 40% of your net income. Ideally, it has to be lesser than that, but in case that home loan is generally a higher, priced loan, not in terms of the interest which you pay, but in terms of the total amount or money value which you take from the bank or banking institutions. So in case if you are taking a very high amount of loan, then make sure that the EMI is not crossing more than 40% of your total net monthly income. The second preferred loan which generally people go for is the two-wheeler loan or four-wheeler loan. In this case, the EMI should not cross more than 15% of your net income. And the final one is a personal loan. Ideally, you should avoid taking a personal loan. The reason being the interest rate for personal loan against the other two loans, which is home loan or vehicle loan, is much higher, and hence you end up paying more amount in the form of EMI compared to the home loan and car loan. And in case if you have to go for a personal loan, the EMI shouldn't exceed more than 10% of your net income. Now let's understand this by taking a simple example. Person A is earning 50,000 Indian rupees per month as his net income, and the person B is earning 1 lakh Indian rupees monthly as his net income. So person A, who is earning 50,000, if he is going for a home loan, that means, and if his EMI is 40% of his net income, so his EMI shouldn't cross more than 20,000 rupees per month. For person B, it should be not more than 40,000 per month. And in the second example, for a car loan, as we mentioned, it should not cross more than 15%. So person A, who is earning 50,000 rupees per month, his EMI should be close to around 7,500 per month. And for the person B, it will come around 15,000 rupees per month. And in case someone has taken a personal loan, the EMI should not cross more than 10% of the net monthly income, which result into person A. For person A, it is 5,000 rupees per month, and for person B, it is going to be 10,000 rupees per month. So that's about how do you ensure that you are well within a comfortable or a caution state, and you're not crossing any time into a stage where it will put you into a stressed state or alarming stage. But friends, we have seen there are times when you end up taking multiple loans or a single loan for which the amount you are paying is very, very high. In all those circumstances, if you put together all your loans or even a single loan for which you are paying a very hefty EMI, it shouldn't cross more than 50% of your net income. As we have already discussed, an ideal state is to be into a comfortable or a caution state. But in case if you are still ending up into a stage where you end up taking almost close to you are paying almost close to 50% of your net income as an EMI, then it is really a time for you to come back, assess all your loans, and see how you can reduce the burden. Now let's take an example of home loan. Generally, we end up taking a very higher amount in the form of loan, and that results into higher EMI per month. So you must have heard about how keeping money invested for the long term reaps the power of compounding. When in loans, it works just the other way. The longer the tenure, the bigger is the interest burden on the borrower. if you take a loan of 9.75% for 10 years, the interest outgo will be 57% of the principal amount. This figure jumps to 91% if the tenure is 15 years and shoots up to 128% for a 20-year loan. In 25 years, the interest outgo is 167% of the principal. So there are times, when we think that since we have taken a loan for a longer duration, which is 20 years or 25 years, and the EMI, reduces, the amount which you pay per month reduces. But what we don't realize, the interest what we are paying on that loan also increases by a very large percentage. So if you have gone ahead with a loan tenure of 25 years, the interest which you pay on the principal is almost equivalent to 167%, which is very, very high. So is it wise to reduce the tenure, of your loan? The answer is yes, because if you are able to reduce the tenure over a period of time, because your paying capacity increases, because every other year you get increment and you can actually pay off your loan much earlier than the actual tenure. And if you do that, you are able to pay off your EMIs and you are able to close your loan much earlier, and the balance amount you can invest into a growth instrument so that you are earning rather than paying EMIs. So we'll take another example. Let's take an example. You have gone for a home loan and the tenure to pay the EMI is 25 years. So in case if you want to close your loan just within the 10 years time, then all you have to do is you hike your EMI by 10% every year. That will result into shortening your tenure from 25 years to 10 years 2 months. So that will make you debt free much earlier in your life than waiting for 25 years to close your loan account. The second option is, in case if you're not able to increase the EMI by 10% every year, you can think of increasing the EMI by 5% every year. That will result into reducing the tenure to 13 years and 3 months, and you'll be debt free much earlier again in this case. The third option is that if you're not able to increase even by 5% of your EMI every year, right? When I am saying 5% every year, that means you are actually increasing 5% of EMI and you are paying 5% more every other year, right? So the third option is pay one extra EMI every year. So that means instead of paying 12 EMIs, you're paying 13 EMIs every year. That will still help you to reduce your loan tenure from 25 years to 19 years 3 months. And the final one is that in case if you can't execute any of these options, then you just go ahead with the regular EMIs. So in this case your EMI remains constant and you will close your loan account in the 25th year. So why we took this example, because if you are able to close your loan earlier than the tenure for which you have taken the loan, that will help you to reduce the interest which you are paying on the principal amount, that is the total amount of loan which you have taken, and all the savings which you have made or which you are going to make because you have closed the account much earlier than the tenure. The same amount can be invested into the different money growth instrument, which will not only help you to grow your money faster, but also it will help you to attain your financial freedom much earlier in your life. So thank you friends for watching this video. All the very best in your financial planning. I'll come with the part 2, so make sure that you watch the part 2 of this video to get deeper knowledge on this subject. See you soon. Bye bye.